Perfect. Well, let the fun begin. Ladies and gentlemen, welcome to the lecture on tokenomics. Of course, Daniel has done the lecture on utilities a couple of days ago, and that was the principles and the fundamental principles behind launching a token, why you should have one, the purpose of the tokens. And today, we're going to discuss the more tangible numbers behind some fucking hair. Behind actually creating the supply side and the demand side of tokenomics that people love doing. So, obviously about Simplicity Group, we've been through this, a lot of clients, a lot of FDV, a lot of tokenomics. But let's jump right into it. Just a quick refresher, just in case you weren't on the previous lecture. And this is also because we're going to go into the economy side of things for a few slides in a second as well. But let's say you are something to earn. Let's say you're a move to earn project, right? Your token in that case would be a medium of exchange. A user completes an activity, gives its data to the company sells the data, buys back the tokens with the revenue, and then sends the token to the user. It's a very nice and easy payment system. And the purpose of that token, it's that sovereignty that Dan was talking about a couple of days ago, where anyone around the world can easily be paid, right? If you want to pay people in dollars, well, you can't have any Russian users, for example. Now you can. It's super easy. You have your own currency. The value comes from the monetary side of things, from that payment, from the fact that you can get everyone on board, but also from the data, the shared data that the users provide that you end up selling, and then you end up buying back the token with the proceeds, right? So that's where the value comes from. And now let's visualize the economy, because this is what you need to do first. You need to first do the utilities, then you build out the economy, and then you can work around then you can calculate the tokenomics, the supply side. So once again, you're a move to earn project. This is roughly speaking what your economy will look like if you are not a scam project, but just a real company. So this is our move to earn box. And over here, we have the advertisers. So this yellow line is us, the company. Let's say the company is called M2E. We're selling data to the advertisers, and they're paying us in this black arrow, which is our fiat currency. And also down here, we have our partners. Let's say McDonald's, they are giving us vouchers, but they're also paying us to advertise their vouchers on our platform because we have so many users. So they're paying us, and the advertisers are paying us for the data. Now, let's add in the token. This is our lovely user over here. And what we do with this money that we get from the advertisers and the partners, we buy back the tokens. So we put dollars into the exchange and we take the tokens out. Then we give those tokens to the user, who then sells them to the exchange. Very nice and simple cyclical economy. Honestly, super easy. Now, let's slow down the velocity. Let's not just allow the user to sell all the tokens instantly. Why don't we introduce some other stuff that they can do? We introduce governance. No one really cares, but let's just say some users do, right? Maybe you want to expand into a new market or something, right? So some users now spend the tokens on governance. And also they spend the tokens on vouchers. So they buy some vouchers with the tokens. You just burn the tokens, right? Because you got the vouchers for free anyway. Well, in fact, you got paid for the vouchers. So now you burn the tokens. So now the user doesn't have that many tokens to sell. So we've slowed down the velocity a little bit. And with this logic, by visualizing the economy like this, you can see your revenue, you can see where the tokens are coming in, where they're coming out, or the injection, the faucets and the sinks, more officially known. You can see who the partners are, who the users are interacting, and so on and so forth. And from there, we can calculate all of that. So it's pretty simple. Let's go into the calculations now. Let's say the advertisers are giving you $50 for your data. And the partners have also given you $50 for this marketing. Well, you use the $100 to put that into exchange and obviously take out, let's say 100 tokens. One token is $1. Take out 100 tokens. You then give those 100 tokens to the user, who then sells them to the exchange for $100. In essence, what you've done is given the user $100. But again, because this user might be in Russia, China, North Korea, whatever, they're still fine, right? This is why we have the token, and this is equilibrium. You put in dollars, the user takes out dollars, nice and simple. Now, let's see what happens when you add the VCs. For example, VCs, right? They have some tokens, they want to sell them as well. So they sell, 20 tokens into the exchange, and they take out $20. But remember, the user isn't going to sell 100 tokens. They spent 10 on governance. Let's say they're staking it for a long term, conviction governance, if you will. And then they spent 10 tokens on the vouchers, right? So now they only have 80 tokens to sell. Well, great. The VC selling 20, the user selling 80. but you're buying back 100. Once again, we're at equilibrium. The price is going to go sideways, nice and steady. Obviously, ceteris paribus, liquidity and other factors and so on and so forth. But all else being equal, this is the fundamentals of how this works. Now, let's see what happens when maybe the VC. Oh, hello. I don't know why that skipped twice. Maybe the VCs, they're not here. The tranches ran out, or maybe you didn't even fundraise. Well, the user's still only selling 80 tokens, but you're buying back 100. The token price is going up. You're buying more than the user selling. Amazing. Nice and good, easy, logical economy. But let's say you don't understand what you're doing, and the VCs have super short vesting schedules. Well, they're selling 100 tokens each month. The user selling 80 tokens each month, but you're only cashing out 100 tokens. Or in dollar terms, obviously the inverse and the blue numbers. Well, now we have a deficit. Now the token price will keep falling because you're not buying enough tokens compared to how many tokens are entering the market from the VCs and the user. Now, this is basically like, in primary school when you get taught a physics concept and it's super simplified, like atoms, when atoms, they look, like just a circle with like electrons on an outside. That's not actually what they look like, but in primary school, that's what you're taught they look like. This is the same thing, right? Obviously, it's a lot more complicated, but it's not really that much more complicated. This is, generally speaking, the fundamentals. If you have an infinite liquidity, or in this economy, let's say you have $1 million in liquidity, this is literally exactly how it would look like. You put in $100, you take out 100 tokens, and the price will basically still be $1. But this is oversimplified, but not really, if that makes sense. Now, we can work backwards to create the supply side, which most people refer to as the tokenomics. Tokenomics is made up of two things. So first of all is the valuation, which is your supply and demand. And then you have the distribution, which is your allocations, your vesting schedules, etc. Now, supply and demand is a quick economics course. Is visualized like this. So you have price on this axis and you have quantity on this axis. What this red line, this D, means is that, simply put, at this price, let's say this price is $10. If we draw that to the D line, which is the demand line, and we draw it down to the quantity line, so like how many people, right? Not a lot of people want to buy something at $10. However, the supply side, which is this line, if it's $10, well, then there's a lot of people that want to sell at that price. And of course, as you drop down in price, if the price is $1, well, then a lot of people want to buy, but not a lot of people want to sell. In the middle is known as the equilibrium. That is where your supply and demand meet. That is what your price will always end up being in a free market economy. So we'll go into a more live example of that in a second, but let's get one thing kind of very clear. The valuation is your token supply by the token price, right? But looking at token price standalone doesn't really make sense. Your token price can be 0.00001 cent. It can be $10. It can be $100,000. It doesn't matter, because you need to know what the supply is. I can have one token worth $100,000, or I can have 10,000 tokens worth $10, or like a gazillion tokens worth this. I still have the same value in my wallet, right? So the valuation is what's important, but valuation, price, same thing basically, but we're just removing supply from the equation. So when I say valuation, realistically, we're talking about that token price, if you want to look at it that way. But it's the same thing, right, in principle. And your token's valuation must make sense relative to demand, otherwise you're going to go to zero, just like bearer chain. Now, bearer chain went to zero for a lot of other different reasons, of course, not just because of pure supply and demand, but it boils down to the fact that nobody wanted to buy the token, so it went to zero. Now, the fun stuff. Let's go through a live example right now. So this chart looks great, right? The market cap, it's actually fully diluted market cap. I don't know why the DEX screen or whatever wasn't updated, but that's the fully diluted market cap. This looks fantastic. It's only going up, a little bit of a retracement, but that's fine. This looks like a great project. Well, I spoke to the founder and I asked, hey, quick question, why did you launch at $40 million? So right now, it's at 44, but they launched at this price over here, right? So that's $40 million they launched at. And I was like, why did you launch at $40 million? And he replies, well, it's because we distribute 20% of all the revenue to our stakers. Great. If we look back at what I was just talking about, let's just calculate that, right? So we distribute 20% of all the revenue. That means that they need approximately $200 million worth of revenue over the course of their whole token vesting. Let's say it's 4 years, 48 months, standard stuff, right? 12-month cliff, 36-month vesting, whatever. They need about $200 million worth of revenue, or approximately $50 million per year. Why? Well, because if I'm earning, let's say 40 million, let's say I own all of the token supply, right? And I get 20% of all the revenue. I'm only going to earn $40 million in the course of, let's say, 4 years. So that means that the project needs to give me $40 million worth of rewards. Well, they don't have that or anywhere near that. As a matter of fact, they're projected to make $400,000 this year, or about 1/500th of what they would need. And again, the reason is very simple, right? Why would I buy $40 million worth of tokens to earn 40 million divided by 2,500? But why would I buy $40 million worth of tokens in order to earn, 400K, let's say 100K, right, this year? That doesn't make sense. Why am I buying $40 million worth of tokens to earn 100K? Oh, sorry, not even 100K, 80K. No chance, right? It doesn't, it's simple. Doesn't make sense. It's broken. And obviously, as investors, the team and everyone else sells into nobody buying, because why would you buy this? They're not making the revenue for me to buy this. It doesn't make sense. Well, the token's going to go to zero. It's that simple. And here's the reason. If we go back to our lovely demand and supply chart, well, right now at this valuation, again, valuation, price, same thing. Nobody wants to buy the token because they're only going to get, 80K per year, right? Maybe that will grow, sure, hopefully, but they're only going to make 80K this year. And at this valuation, that doesn't make sense. I'm going to buy $44 million worth of tokens to earn 80K. No chance. However, the sellers, the VCs, the team, oh boy, they want to sell. They want to sell at this price. Of course. Why wouldn't you? Right? Because the price is high. And over here, we have a supply. Oh, sorry, that shouldn't say surplus. I should say deficit. That's quite funny. This is a supply deficit. Oh, no, I lied. Sorry. It's a demand deficit or a supply surplus. Sorry. Supply surplus is accurate. Basically, what this means is that there's just way too much supply compared to the demand. This over here is a quantifiable number. And what will happen is as more and more people sell, and again, nobody buys, because why would you? The price will just keep dropping and dropping and dropping and dropping and dropping until it reaches equilibrium. And equilibrium, according to my calculations, is approximately $2 million. $2 million FDV. So again, it's that 400K multiplied by 4 or 5 years vesting schedule, whatever. So that's how this works. That's how you need to calculate your valuation. Anything else is wrong, and you will go to zero. It's that simple. Everyone that didn't listen to us when we told them to reduce the valuation to something more sensible, something that's based on their users, their token price charts look like that. Because this price over here, for example, if I go back to my lovely Bearer chain, wherever it is, probably shouldn't have done this by, oh my God, I've lost it. No. Is Bearer chain here?
I think it was before the economy.
Yeah, okay. I didn't have to go back. Thank you. So this right here, that's the equilibrium price. It's 62 cents or whatever the market cap is. Again, price, market cap, same thing. Right? So launching here doesn't make sense. You should have launched here because that's where then your token price will go like this. It'll go sideways, right? That's not bad. This is terrible. This is a ski slope. Well, it's a dangerous ski slope. So that's simply put. All it is. It's just a very simple calculation of, okay, we have this much buy pressure. Then that means our valuation should be this much. Thinking of the valuation first is okay. You can do that. But you then need to wait until you have the buy pressure necessary to sustain it. So, for example, if you think that you should launch a $100 million valuation, that's fine. But you might need to launch in 2032 when you have 10 million users. Because right now you have 10K people on your beta whitelist. Doesn't make sense. Again, it's that simple. And how you calculate it, is, well, basically what I've been saying. So you find your revenue. Let's say your revenue is just buyback, your buy pressure. Let's say it's just from buybacks Of course, you will have buy pressure from, people speculating on the token. Maybe you do a lot of good marketing. You'll have buy pressure from people actually using the token. Maybe you're paying for transaction fees, whatever it is, right? But let's just simplify. Let's say you have only buybacks. That's the only thing that's buying the token, and you have 500K. Well, you can structure your tokenomics and you can calculate the sell pressure. This is a deterministic calculation. It's assuming your token price remains at launch, of course. But here we have, I don't know if it's visible, but we have, 1.5 million, 500K, 700K, and then we drop down to below 500K. This is okay, because in these first few months, you're going to have a lot of hype, a lot of, people buying the token just because they're speculating or whatever. And then we go down to a reasonable equilibrium. Again, you have more buy pressure than you have sell pressure. Fantastic. Your token's going to go sideways, if not up. Not down. That's the only thing we care about. We just care about the token price not going down, because if it goes down, your reputation is ruined. Everything that you've been working for the last few years, gone, donezo. Nobody wants to work with you again. You're not going to fundraise again. You're not going to get partnerships. Nothing matters. You have lost. You have to go back to Web 2 or become, a service provider like some other tokenomics people out there. I'm not going to name names, but probably people know who they are. Now, let's look at the distribution. I've highlighted a few people, not a few people, I've highlighted a few sections over here. These are kind of the main sections, right? You have the allocations, in particular, the allocations to VCs. This is a screenshot from another presentation, but, you have your allocations. You have the raise amount, which obviously is determined by the by the allocation and the token price, or valuation. Again, same thing. Then you have the cliff period, you have the vesting period, and you have the available at TGE period, which realistically should be over here, as it is in our new template, which I'll explain in a second. And another key part is your liquidity allocation over here. But anyways, point being is just how you distribute the token. Where are they going, and how long will it take them to get there? That's your distribution. Generally speaking, I don't want to, flick. Actually, to be fair, I can actually do. I forgot that I can just click this button. Generally speaking, this is what modern day distributions look like. You have about 20% or so to investors, plus minus 5%. You have about 15% to the team and insiders. Whether it's team, ecosystem, foundation, whatever. Not ecosystem, foundation, whatever else you want to call it. About 15% plus minus 5%. You have about 25% to the company, so that's like your treasury, your liquidity, etc. And then you have the rest to the community. Obviously, it vastly depends. If you're layer one, you're going to have different tokenomics to DeFi project, to a pump fund competitor, to a polymarket competitor, whatever it is. It all depends. But there are kind of some rough rules that you always can follow, and those rules are the opposite of this. So common mistakes with the tokenomics is you have high valuations, right? So again, you have just too much sell pressure. That's what I was talking about before. It doesn't make sense. You don't have enough buy pressure. The other thing is short vesting schedules. Don't give very short vesting schedules, right? If you're fundraising and investors are investing into equity, well, the token is just a little cherry on top. They don't need to have a token with a 12-month vesting schedule. It doesn't make sense, right? It should be a long, nice, standard equity sort of vesting schedule of 4 years, maybe 3 years. Again, depends on the market conditions, depends on what the project is, depends on how much hype you have, depends on your cap table, depends on the time in the market, depends on a lot of stuff, but it can all be boiled down to just logical things. Like, we don't need to have short vestings for the team members. Why would we? The team is getting a nice monthly income, right? They don't need tokens. It's just a little cherry on top, so they can have a long vesting schedule. Also, another thing, unfair allocations. So, for example, if the team has 50% of the supply, why are you not getting paid, right? If the team has 30% of the supply, why are you not getting paid? That's why it's about 15% plus minus 5% or so. The investors shouldn't really have 50% of allocation, but again, depends on the project. If you're super crypto, super low valuation, doesn't really matter, but most projects are not. So going above like 25% to investors also doesn't really make sense. And not enough liquidity, a very popular one with a lot of founders. They just don't know what liquidity is. So, if you don't have enough liquidity, then if I have some tokens and I sell them, then your token price will just go skadoosh all the way down. Interestingly enough, that project that I was talking about earlier, they're actually increasing the liquidity. So since the moment I screenshotted to when I checked this morning, they actually doubled or tripled the liquidity. But still, so it's a lot better now. But nonetheless, if I was to sell $1,000 worth of the tokens a week ago, the token price would have dropped by, like maybe 10% or something. Not great. And lastly, not appealing to investors, exchanges, launchpads, right? If they're not appealing, then you're not going to raise with it. This is more so, again, back in the days when people are investing into tokens. Nowadays, investors care about equity. But still, you need to make them appealing, roughly speaking, to the parties that you want to work with. Now, this is a bit of a Q&A. Let's get some community engagement in this lecture. And can someone tell me the problems that they see with these tokenomics? Bear in mind, these are from our client examples. There's 4 of these examples, and I know they're numbered a little bit, so you can cheat if you will. But I see a hand, and I see it's Dan's hand. So I think we'll give everyone a second just to ping a message in the chat. Maybe someone can can give some thoughts, and then if not, then we'll give Dan the microphone to answer this question very well. Okay.
I personally think that they are not raising enough money.
Okay.
They are in crypto and they should be raising 100 million. And I see that the token value of their raise is cumulatively only about 350 million. 3 million and 500,000.
Yeah. I was going to say
they should be aiming for the stars and going for that 100 million mark.
I see. I think from now on, if anyone else would like to unmute and speak, that'd be great. No, but yeah, I mean, a lot of founders think that they can raise a lot of money. We still have those conversations. Hey guys, we want to raise $50 million. What do you have? Oh, we have an MVP. We vibe coded it last weekend. Oh, okay, great. You're not raising that amount of money, obviously not, right? So that's a separate point. But yeah, okay, I see 0 comments in the chat.
More seriously, the vesting schedules are far too short.
Yes.
Although, a little caveat, it depends on how much users they have and where they are when they launch.
Yes, very correct. Yeah, exactly. If this project, we have the token value, so the more astute people can probably calculate the valuation. I think it's about $30 million, if I'm not mistaken. But yes, if they have 20 million users, then these vesting schedules are even too long. You can just give all your tokens to all the investors at launch and you'll be fine, right? Maybe not that extreme, but yes, it very much depends. But generally speaking, these are quite short. And also over here, we have the strategic round, which has vestings that are very close to the public round. 1 month cliff and then 5 instead of 4 month vesting. But the valuation is much shorter, which means that if the token launches and just goes sideways, the people in the public round, they can't sell. They're going to sell at net 0, right? What's the point of them selling? But the people in the strategic round will be selling because for them, they're in profit. But the vesting schedule is basically the same. So it's quite unfair on people in the public round because the strategic round is just going to dump all the tokens and that's it, right? So that's another little note. You need to always kind of think about the relationship between the vesting schedules, between the different tranches. Here's another example, another one of our clients, if you will, before we help them out. If anyone would like to give a guess, please feel free to jump in, unmute, or ping in the chat. Be keen to see. Again, it's kind of numbered, so a little bit of cheating going on, but it doesn't really matter. Just to not sit in silence, I will keep waffling.
I guess I can jump in, and I will say that this time there is not enough tokens going to investors, first of all. I think investors are the priority and they should be able to make money from your project. And clearly here, they're just not going to make enough money.
Completely agreed. And the best
sorry to cut in, but yeah, community has a lot of, they don't have a lot of, they have a lot of tokens and not a lot of cliff investing. So they're investing also TG 20%. Their community, but they're probably going to sell very easily.
Yeah, that's a good point, because yes, they do have a lot of allocation and they probably will sell. It depends on the token price though, again, because if the token price just stays at this amount, or maybe even drops by a little bit, they probably would be disincentivized to sell because they're just going to be selling at a loss. But on the community point, this project thought that they can raise just under $10 million from the community. That is never going to happen, right? Unless you're a massive project. And to be honest, whenever you hear about those, oh, we raised $100 million from Fjord, it's actually probably just 10 whales that they're very good friends with, and then, you know, like however many people. Right? That's probably what happened. $100 million in a public sale is just obscene. No amount of marketing can get you that hyped from your user base, right? So this is just not going to happen in 99.999% of cases. And also the whales would rather invest into cheaper rounds anyway. Over here, another problem is the fact that the angel price is much lower than the community price. So again, for them, even if the token drops by, well, I don't know, 70%, they're still in profit. They're still going to dump, right? Because whilst everyone else is trying to hold, waiting for the token price to go up. Now, this isn't really that much of a problem, to be honest, because if the angels invested 5 years ago when you had nothing, and now you're partnered with, I don't know, Apple, well, you know, fair enough, right? But this is something to keep in mind, as again, is the relationships between the different tranches. And of course, the allocations to investors in general is pretty high. You know, this is what, 30%? Yeah, 30% over here. That's quite, the community is okay, but 30% to investors over here, that's a bit much. Generally speaking, again, it's all depends on the project. Here's another one. Please, if we have any takers, once again, they are numbered, but still, if anyone has any ideas, please feel free to ping them in the chat.
As an investor, why am I only getting 10 to 20% of my tokens at launch? I should be able to dump on my community instantly. On your community, sorry. On your community.
Van is playing a great devil's advocate. That's cool. But yes, well, correct evidence, which is the available at TGE, very much depends, again, on the project, but generally speaking, this is a bit high for investors, especially nowadays. Over here, the cliffs are very short, the vestings are very short. So all in all, this is very lucrative for investors, but, you know, might cause some problems when it comes to managing all the sell pressure if you don't have the user base, if you don't have the hype, etc. And over here, another quick little note is, what is the problem here? To be fair, I don't really see a problem with that. Never mind. So, do you have one more? No, we don't. Now we go to the live example. So, what we're going to do is we are going to build the tokenomics from scratch just to showcase how pretty simple it is to figure out your fully diluted valuation, ceteris paribus, you know, all things considered. So, if anyone would like to unmute and jump in at any point, please do. But otherwise, I am just going to be imagining a project on the spot and just thinking of some random numbers here. So let's say we go back to the numbers that we saw in the presentation earlier. Let's say we have 500K a month worth of buybacks because we are just so successful and we have, what's it called? And we have a lot of revenue, right? So 500K worth of buybacks. Maybe in the next month, it's, you know, 500 and let's say 5K, right? And let's say it grows by a nice steady 5K each month, right? Because we're growing, you know, very steadily growing, but still growing nonetheless. Now, let's say from the speculators, you know, let's say we've done some PR with our good friends at Paragon. And let's say they have gotten us onto Bloomberg and onto, what's it called, on BBC News and so on and so forth. Well, in that case, we're probably going to have a lot of people speculating, you know, they're just going to buy the token thinking it's going to keep going up because we're super successful. Kind of like Cardano. Cardano has absolutely no value in the ecosystem at all. But, however, they have a lot of speculators that are just buying the token because they think Cardano to the moon, which is a lot of value in and of itself. And it's very, very substantial. You know? I know I kind of diminish the speculative buy pressure, but it's very, very important. And if you have that marketing, if you have that clout, well, the speculators are going to do a lot for you. They're going to buy the token, they're going to hold it, they're going to put it to their ledger, and they're going to forget about it. Amazing. That's what you want, you know, for your token price. So let's say speculators, let's say you have, I don't know, 1 million people. I mean, you have 1 million followers on Twitter, and they're all real, and each of them is going to buy, let's say they're slow investors, right? Let's say they buy just £2 per month, right? It's a DCA kind of thing. Or, you know, let's be a bit more realistic. Let's say you have 100,000 people and they each buy £20, you know, each month, right? So that'll give us 200K. And let's say we're not growing, we're not doing. We hired Paragon and we hired LKI, but now we're not really doing much more. So we're not growing in the speculator. So let's say it's just consistent 200K. Now, how many users do you actually have? Maybe we're a transaction protocol and they buy, they spend fees in dollars that automatically buys the token from the market and burns it. Let's say that's your token utility, token economy. So let's say you have, again, 100,000 users, or well, you have 100,000 speculators. Let's say they're also your users, and they each spend about £1 per transaction fee. And let's say they don't grow. So there you go. Well, now we've calculated the buy pressure. Of course, again, there is a lot of recursion. There's a lot of randomness, a lot of complexities, different utilities, different marketing, exchanges, regions. Everything is a massive puzzle. It's a very, very massive 100,000 piece puzzle. All comes together nicely. But, you can kind of, roughly speaking, if you can't afford a proper service provider, you can, roughly speaking, figure this out anyway. Boil it down to the basics. We get, over the course of 24 months, we have a total of £20,500 going into buying the token. Well, again, going back to the very nice and simple, what's it called, supply and demand chart, that means that we can give away £20,500 worth of tokens. Right? Let's just assume that these are all in dollars because that's just easier. Just click on pounds again. Hello? Oh, you're done?
I'll let you finish first.
I'm going to go into the main. We're going to be building the whole token.
Let's quickly go back to that. I have a question. So you are saying you can give away 20.5 million tokens here because you are going to have that much in buy pressure.
Yeah.
But how do you account for future buy pressure? And what I mean by that is, let's look at something like Tesla stock. Tesla is inherently currently not valued anywhere. Well, it's not making enough revenue to match its valuation. And that's because people believe in the future it will grow. And I know that kind of comes under speculators. But if you are giving away each month or buying back at, let's say, $1 million each month, and by the 5th year, you would have had another 36 months of buy pressure, which is 36 million. How do you account for that? Or would you just not consider that when designing your tokenomics?
Yeah, so great question. Thanks for that. So there are two answers here. Number one, the easy answer is, account for what you can account for, and then do a sort of discounted cash flow-esque valuation. So, for example, we know now we're going to get projecting about $20.5 million, let's say, instead of pounds now, worth of buying pressure. But we have a massive partnership with Apple on year 3. We have the LOI. It's all signed. We just need to get the tech out there, whatever. You can just ignore it. If that actually happens, then you have a lot more buy pressure. All of a sudden now, this becomes 2 million a month, and all of a sudden you have $40 million or whatever, right? And that just means that your token price will now go up. Instead of trying to launch at that future potential valuation, just launch at what is reasonable now. And, maybe you can account for some, again, discounted cash flow. So let's say right now it's 20 million, maybe next year you're projecting some more growth, but it's not that likely because it's not real data, it's just an assumption. So instead of, going at 40 million, maybe you go at 25, 30 million, right? So you can kind of account for that, but as long as you're sensible, still what should happen is as you grow and succeed, the token price should go up as there's more and more buy pressure because you launched at a valuation that was reasonable for the time of launch and not trying to predict what it would be in 5 years' time. Because then you're going to launch at that high valuation, and then until you get that Tesla partnership, those 2 years, well, your token price is going to drop because you don't have the buy pressure enough to sustain it. And now people think you're a scammer. Tesla says, no thanks, deal's off, bye-bye. So you've just shot yourself in the foot, the leg, and you've shot your entire family. So I'd say just launch at a reasonable valuation for the time that is now, maybe add in a few million on top. Maybe you have a big partnership coming up. You can scale it, but it depends on the buy pressure. It depends on your partnerships, signed letters of intent, and a variety of different things.
And then a follow-up question: what if I have an absolutely great relationship with my investors and they promise me they're not going to sell, and I, as a team member, also, why would I sell my own token if I believe in my project? There's going to be no sell pressure then. So surely I can just choose any valuation and pluck it out of my backside for lack of politeness.
Yeah, no, of course, yeah. So you definitely can, of course. Generally speaking, we have heard, I don't know, I can remember about 4 cases right now, and those who know me know that my memory isn't the best. So we probably had 10, 15, 20 leads tell us that over the course of the last 4 years. And not just random people, but just like actual leads that we got on calls with. They all went to zero if they launched at all. Because that is obviously never going to happen. Your investors do not invest to hold your tokens. That's a lie. What they will do, however, is they will wait for your next round and then sell OTC to the lower down investors. So you have Coinbase Ventures. Okay, I don't know about Coinbase Ventures, I don't know. But let's say you have a big name investor. They invest, all of a sudden your valuation jumps 10x. They're cashing out the next round. They're just going to re-sign the SAFT to a different wallet. You're not even going to know. And that's it. So they're already out. But yeah, they're not selling the token. They don't have any tokens to sell. So that's what I would say. So yeah, if you think that your investors are never going to sell, they will, all of them. And also, it's very bad for you to even think that they shouldn't sell. I would wager the investor's job is to dump the tokens as soon as possible. They're a simple business. They get money from LPs. They need to get the money back to the LPs. That's it. Right? They shouldn't be holding your tokens. Investors that dump tokens, in my opinion, should dump tokens. In fact, they should have dumped them even sooner, because they're an investor. They're not your friend. They're not a user that you're trying to, whatever. So I think it's very bad for founders to expect investors to not sell tokens, as a little caveat on top.
I think that's a very key point. Thank you.
Thank you. Now, we know that we have 20 million in buy pressure, and let's say per month that's about 800 to 900k steadily growing. Well, let's just jump right into it. Let's say we have whatever amount. How much is that? Let's say 10 billion tokens, which means that we should have a price of 2.8. Hello, no, that's not what I meant. 2.8. Just like that. Oops. Yeah, what's going on?
You changed the IMC when you typed in by accident.
Yeah, there you go. So yeah, this is it. This is all we do. It's this simple. If you do anything else, you're probably going to go down in price as soon as you launch. I cannot overstate that enough. I've been saying it for 4 years, and there have been so many founders that decided that they were better, and they were not 100% of the time. So please just do this. Don't increase this. You can maybe we can round it up. Maybe we can make this stop free. Maybe you're super bullish. You're super. You have LOIs and you have patents. It's made that 35 mil. That's it. Don't increase it anymore. You will go to zero. It's that simple. Because this is the thing. You might not go to zero. You might go down from 35 million down to it's 20.5. This should have been. Sorry, there should have been that. Sorry, my bad. So maybe we can go up to like 25 mil or something. There you go. This is what I meant to say. I forgot the zero there. Because what will happen is, the equilibrium price might be $25 million, or maybe it might even be $20 million, right? But if you start higher and your token price starts to go down after 2 months, nobody's gonna buy it. This is the same problem in economics as deflation. If the prices of goods and services is going down, people spend less because they wait for them to go down further. Deflation is arguably worse than inflation in an incredible amount of ways because of that sheer fact. People just wait for the token price to hit a floor or to just drop lower so they can buy more tokens. Give it 3 more months and they think, oh, the project's dead. And that's it. Your LOI is done. You might have been the equilibrium price may have been $20 million, but you've bottled it in the first few months, and now people think that you're a scammer. And again, that's it. Goodbye to your wife, goodbye to your kids. They're leaving you, right? You wasted 4 years of your life. Why? For what? Because you wanted to have $50 million on this sell over here. It doesn't make sense. And again, I've said this to so many founders, and I see their tokens after they launch because they ignored the advice, and it just genuinely upsets me because all they had to do was just settle down a little bit. Be a bit more humble and just think, okay, well, instead of the pixels over here lighting up, it should be slightly different looking pixels. That's all it is. But let's move on. Anyways, we can hide this. We can hide these over here. By the way, this whole template, As you can see, it's quite busy, and we have a lot of other stuff in this template. We have we have some instructions over here. We have a liquidity calculator. We have a bunch of other stuff in this template. You can find this. I will link it in the Accelerator chat afterwards. But this is all free. It's all completely public. You can just go and use it yourself. I highly recommend it because, in my opinion, it is the best template that is out on the market, because everything is all nicely, concisely right here, rather than being split over random pages and so on and so forth. Lest we can hide these as well. Let's say, again, if anyone has any ideas, please feel free to ping them in the chat. But I'm just going to spit some numbers out. Let's say we have 10% to the seed, 5% to the public round, private round, and let's say 2% to the public round. The prices, we don't want to have a price that's too different. So let's say 0.00, let's say 0.8, a nice little 3x for them. Let's say 0.015 over here. Not that, let's do 0.0. They're still investors. Let's give them something. And the public round, we can do 0.023 or something. Give them a little bit of a discount as well. Available at TG, let's say 5%. Let's say 20% again. Launchpad round, 1 month cliffs. Let's do 4-month vesting. The market isn't that great. Cliffs wise, standard 12 months, 10 months. Let's say vesting. Let's make this. Well, it's not a lot. They're only going to sell $800,000 worth of tokens. I feel like with my buybacks, I can easily buy this. So we can make this quite short. We can make this 20. We can make this, let's say, 18. Nice and incentivize them. For the team, of course, let's say 15% maximum. Now let's say 10 because we want to give free to advisors. That should be 12 then. That's 15. To liquidity, let's say a nice comfortable 8%. Generally speaking, between 6 to 9%. Depends on the project. Again, of course, depends on your valuation, blah, blah, blah. But about 8% is fine. Let's say you have some airdrop rewards, whatever. Well, you're a community guy. Let's say 15% there, or gal. And then to the treasury, 45%. Treasury, slash ecosystem. There we go. I have just made all of these numbers up. But again, let's just think about these logically. If you have a big community, you're a B2C project, well, then you need a big ecosystem tranche. If you're B2B, first of all, why do you have a token? Well, I mean, unless you're infrastructure, of course, that makes complete sense. If you're layer 1 or deepen. Otherwise, it doesn't. And secondly, you probably shouldn't have allocation this high. Maybe you are a deep science, deep tech project. You need a lot of money. Well, maybe you can raise this to 15% and this to 10%. 27% to investors isn't bad because we're a deep tech project. We need that capital. If we are a move to earn project, which can be vibe coded in about 4 seconds, we do not need more than this. Again, raising amounts is also something that a lot of founders just put willy-nilly numbers. Oh, we want to raise $10 million. For what, may I ask? Oh, for the team? No, that's not how it works. So raise sensible amounts when you know exactly what you're going to spend the money on. And then here, vestings, let's just do something simple. 1236, ecosystem, don't need a cliff, but let's say 48. Then over here for liquidity, let's say 6 months because, 50% unlock. You don't want to unlock all of it because then it's obvious that you're just going to dump the tokens because the team owns the liquidity tranche, right? So this is actually a little life hack. If you want to do this, I don't recommend it, but you can unlock a bit higher at the liquidity and no one really will bat an eye, but you also have a little bit of tokens there that now are vest free. So you can sell a little bit of tokens if you need to. Obviously, wouldn't really recommend it because you're just dumping on yourself, but there's a little way to get a little cheeky check if you so desire or need. And let's say rewards, you want to do, a quarter of it, unlock the TGE, then you have a 3-month cliff, and then you have, let's say 9-month vesting. So every month, you airdrop a little bit more tokens. So there we go. Logically speaking, we've arrived at these, everything here. And I have a YouTube video explaining all this in detail. And now if we scroll to the right, well, we can see here, specifically here, this is how much sell pressure we're going to have per month. And if we look down here, we actually have a nice little chart to visualize it. So at TGE, obviously, we have the most, $2.2 million. But then, if we remember from our revenue, we're making about 800 to 900K a month in buy pressure, which means that our sell pressure here, 800K is where it peaks at, but then it drops down to 500K, 600K, 500K. Amazing. What this means is the token price will just go up until it reaches a new equilibrium. So for example, here we have $800,000 buying and only $500,000 selling. well, if the token valuation is 25 million now, in reality, the valuation probably, or the token price will probably increase by maybe about like 50% or so. So you'd actually be an FDV of 40 million. Funnily enough, that's the FDV of that project that they decided to launch at. But now your token price looks like that instead of looking like that, which is infinitely better, and it costs you absolutely nothing. Right? I know, yes, of course, there are some points, like, for example, maybe you do need to raise more money, or maybe you want to come across more seriously that you can get on centralized exchanges or into a better launch pad. That all makes sense. However, what gets you those things is the product. It's the distribution that you have, the marketing, the revenue, the users. These are utility tokens. In theory, realistically, all of this you shouldn't exist. A utility token should just be minted into the market 100%, in a euphoric world, 100% to the market, and people just use it for utility. The fact that there's even a price is already a bit dodgy, if you understand what I mean, right? These are utility tokens. People shouldn't be buying them to hold them, to sell them later. It's not an investment. It's not an equity. It's a utility token. So my point being that if you apply a lot of importance onto the utility token for getting you to certain milestones, you're looking at the wrong thing. You're looking at a bandage to try and instead of a tourniquet. That's not how you should be looking. The utility token comes last, if you will. Again, unless you're a layer 1 project, of course, or deep in where you need the token for your core infrastructure to work, then everything that I've been saying is it's a bit different. So it depends. But yeah, so this is how you do it. And obviously, don't forget token ticker, which we all call test. In fact, I'm not going to call it test. I'm going to call it lect for lecture. I feel like both of those acronyms weren't great, but you get what I mean. So I accidentally pressed stop screen sharing instead of change tab. So I'm just going to go back to sharing screen. There we go. Live example. That was the live example. Hopefully that was fruitful and helpful. And the final words, kind of to summarize everything. Why do most tokens die in launch? Well, first of all, there's too much sell pressure. Maybe you go on Binance and the Binance Alpha program asks for 5% with no vesting schedules. Good game. Thanks for playing. You're dead. Maybe the market maker has a loan agreement and they're a very dodgy market maker, so it's a bad agreement. Right? Loan agreements in general aren't that bad, right? But or they're not bad at all, to be honest. It just depends on your market maker. Maybe the vesting schedules are too short. Maybe the rewards are too high. Whatever it is, there's too much sell pressure. Or on the flip side, the valuation is too high, which is the same as there's not enough buy pressure. No one wants to buy at this price. And of course, there's just not enough buying, or again, the sell pressure might be a bit high because the price is very good for people to sell. Number 2 is bad marketing. Bad marketing, bad distribution. Nobody knows who you are, right? And notice how that's above bad product. Go-to-market strategy actually is a bit of marketing. So this presentation was made, like a year ago. So this probably can move a bit higher up, because realistically, what's important is how many people know about your product. Whether that's because of your marketing, whether that's because of your distribution funnels, which are a subsequent of your kind of go-to-market strategy, which is why I'm saying this probably needs to be above here. But, you can sell a pet rock and you'll still be profitable. So the product comes after your marketing and your distribution and how you're going to get to market. But it's a close second. You need to have a good product. And in a lot of cases, the product speaks for itself, of course. But those cases are a lot smaller than the amount of times that the marketing spoke for the product and then the product kind of caught up, if you will. And lastly, you just don't understand the costs. The listing costs are very high. Liquidity requires a lot of money, especially the higher your valuation is, the more dollars you need to put up for liquidity. There's a lot of legal costs, marketing costs, tokenomics costs. Raising money to do all of this doesn't make sense. You need to have this money. You need to have revenue. You need to have savings that you invest into all of this. And then, then you can succeed. If you don't do any of these things, well, then probably chances are you're not going to do very well. Notably the liquidity part of things. So avoid those mistakes. I will send this tokenomics template in the group chat, and we have a video. So if you go on the template, actually, you can see over here, we have a explainer video, YouTube. Literally just explain. Okay, well, great. There's an ad for Adobe, but it explains how to use a template, what numbers to put in, and basically does what I've just went through. And we also have a course, it's a 3-hour course, and there are videos on tokenomics. I believe it's video 7, but it explains, again, kind of what I've explained here, but in even more detail. We have a lot of content, of course, which are just on our website in the blog section. And a bit of shilling. If you want your token launches to look like this, please consider hiring a specialized token economist, or of course your go-to friends at Simplicity Group. Now, I know Fox Finance doesn't look as great nowadays, but they are relaunching apps, so they're not really focusing too much on the token. So yeah, that is the tokenomics presentation. Hopefully that was fruitful and not jarring to listen to, considering my woes and my pleas for better founder auditory skills. But yes, does anyone have any questions? Shoot away.
So I will take your role this time and ask a question to break the ice. First of all, I see you promoted Adobe. Are you a fan of the software?
I absolutely despise Adobe, and it's one of the worst companies in the world, in my opinion. When you go to cancel Adobe, you can't. So, not a fan.
Second question: are there any tools that exist to allow me to very easily visualize the buy and sell pressure?
Well, it's funny you ask that, because there's this company called Simplicity Group, and they're actually working on a lovely little model tool that will allow you to input your tokenomics, your vesting schedules, allocations, and on the flip side, some buy pressure. And it will use stochastic Monte Carlo simulations to calculate your token price in a recursive manner. So not just we're going to have this amount of users, that'll be the token price. No, the token price will adapt with each step. And as a subsequent, we can therefore calculate the buy and sell pressure each month. And we will publish, well, that is actually the tool that we'll be using to model out all of the token economies for the cohort. But we'll also make that public very soon on our website. Stay tuned for that. And of course, if you just want the supply side itself, then we have the template, and you can see the sell pressure over here.
I am all out of questions, unfortunately, but thank you for that, Alex.
Perfect. Thank you very much for the questions. Would anyone else like to ask a question? Please go ahead. Hello, Chris.
What's a token?
Well, if you were at the presentation 2 days ago, actually, I think you were, to be honest, but a token, it's an empty shell. It's a nothing. It's a zilch. It's an IOU. It's debt. It's a PNG file without anything on top of the PNG background, which is obviously transparent. So, just in case.
Well done. Well done as usual, Alex. Thank you.
Thank you very much. It is my passion to help founders make good tokenomics. Thank you. And yeah, I mean, I guess I'll stick around for an extra minute or so. If anyone has any questions, please feel free to ping in the chat or unmute and ask away. Obviously, if anyone has any specific questions about the tokenomics, then we can book a time separately and discuss. And I'm waiting for Anthony. I still need to review the documents that you've sent me. I'll do that, of course, before our call, and have some ideas there. Yeah, I guess, yeah, if no one else has any other questions, then thank you very much, everyone, for joining, especially those who didn't necessarily need to join because they're not launching tokens, but I appreciate the sticking around. Hopefully it was quite fun and entertaining. And hopefully if you're speaking to your friends and they want to launch tokens, then point them in the direction of our lectures, because honestly, a lot of founders, they just need the help, and they unfortunately don't know where to get it because the internet is noisy. There's a lot of people out there that think they know what they're doing, but they don't. And they never will, but they have a lot more followers or whatever, so they get a lot more attention, but they are typically wrong. So point them in our direction, and hopefully these completely free resources will help them understand what their valuations should be, the vesting schedules should be, and in general how to think about their tokenomics. On that note, thank you very much, everyone, for joining. Tomorrow we have the final lecture of our tokenomics week, which is on modeling, which I am finalizing as we speak. Well, not as we speak, but after I am done speaking, funnily enough. And I will explain how to do deterministic models, stochastic models, when to use them, and when to know when you're getting scammed by a tokenomics provider that is telling you need very complicated models when in reality you do not. So that'll be tomorrow. So same time, I believe. So stay tuned for that. But yeah, thank you very much, everyone. And hopefully this was nice and useful. And I will see you all on Telegram and tomorrow.
Thanks, Alex.
Yes, guys. Stop recording.